in, grab their food, get a spot. I'll be giving a couple of announcements, but just so you guys know, we will be getting started with our presentation at about 12:05 so that the people here can grab their chow. Alrighty, we'll go ahead and get started. Looks like everyone's got a spot. We've got all of our attendees online that are ready for us to get started, so I'll go ahead and kick it off. But thanks for coming today. We're really glad that you can join us for our Lunch and Learn. We got some sandwiches and some cookies and some chips here. So if you aren't joining us in person, you're definitely missing out, but we're glad that you can join us online as well. So today I'm going to run through just a couple of quick announcements, and then we'll get into our meat and potatoes of the presentation today. But my name is Sarah Shellum. I'm our communications communications manager here at Quest and one of our IRA specialists. I love putting on events for you guys, whether that be lunch and learns, socials, webinars, LinkedIn Live events. We have a ton. So these are all the events that we currently have. Right now, we're going to be changing some of the structures, adding some new events, taking away some of them, but you'll definitely get some more information on that a little bit later. But if you ever want to go back and maybe watch a class that you weren't able to come to, you can always go back to our YouTube where all of our webinars will be streamed, as well as Facebook. We have a couple promos going on this month. One of them is only going to be going on until tax filing deadline. So if you're looking to open up a new account, whether that be, any of the self-directed IRAs that we have here, or the HSAs, the ESAs, you can do that at no account opening fee cost. So normally it's about $100 to get started. We are waiving that for the tax filing deadline promo. And then our other promo that we're continuing throughout the rest of the month is going to be rewards for deposits. So pretty much what that means is if you have an account and you are ready to move money over, we're going to just give you a little bit of money to go towards, whether that be a transaction fee, a billing fee, any sort of fee. It's just kind of a little thank you for moving money into your account. It's a way to give back and take some of that pressure off for doing any sort of fees or whatnot. And then, as always, we always have this one going on, but if you want to refer someone to Quest, they will get a $25 credit to their account for opening up a new account, and so would you as well if you've got an account with us. And then one of the most exciting slides, I talked about this one at our Self-Directed IRA Social on Tuesday, but we have set a date for the Quest Expo, and we are very, very excited to be putting this into motion. So do save the date. It's going to be next June on the 28th and 29th. I say next as in like next year's June, not this year's June. For 2024 in Dallas. So the Irving Convention Center, right near the DFW Airport and Love Field, about equidistant to both. It's a great area. We're going to expect about 1,000 people, I think, at that one. We had around 750 check-ins for this past one, and we're just going to make it even bigger and better. So save that date. And then if you have any questions, of course, you can always call us, email us, chat with us, or scan this little QR code to schedule a free consultation. So that's all I have. Hopefully I didn't take too much time because I want to go ahead and get Brian up here with Hornet Capital. He's going to be talking a little bit about Austin housing market, some things, hard money lending, a little bit of more in-depth material than what we're used to. So let's go ahead and give him a big round of applause.
All right. Wait, before you leave. Just left and right, and then how do you do the
and your
red
little pointy is going to be that one.
Okay.
Here you go.
Do I need to do a check with the?
You're good. We can hear.
Everyone can hear in the Zoom call or whatever.
Yep,
okay,
sure
perfect. Can. All right. Well, welcome everyone. Learn. Thanks for coming out. Like she said, I do have some very detailed stuff to go through. It's going to be some. Probably more in detail than the stuff that you're used to listening to, but that's because I'm a nerd and I love data and I love to dig in and get to the base of things so I can make my own real estate decisions. So here you go. My goal today is to see how many of you I can convince to go out and buy some real estate in Austin by the end of the day. All right, so some of you in the group know me, but I know there's also an online seminar, so I'm going to explain who I am real quick. So my earliest days, I do remember growing up in a trailer park with my dad and my grandpa. It didn't stop me. I still worked really hard in high school. I was a 3-sport athlete, and I was also a straight A student. So there's a picture of me slamming myself into the locker as the jock beats up on the nerd. And like I said, I am a nerd, so you're going to see a lot of data here. I was able to get myself into the Naval Academy, got to play baseball for 4 years there, and also from there, got to go do my dream job, go fly F-18 Hornets. It's probably the best time of my life, going out there and doing great things off aircraft carriers. When I got back from deploying, I went out and did some real estate. got my real estate license. I've had that for over 15 years. I started my first company, Tally 2 Investment Group, which the idea was just go out here in Austin and start flipping homes. And did that for 5 years until I grew, continued to grow, had enough investors and enough assets and enough capital that we moved into a fund model with Hornet Capital. I do have a wife and 2 kids, and if I have to sit down today, it's because recently my kids just took me down a double black diamond, and they bounced right down it, and I rolled down it until I couldn't stand back up. So my back is killing me, but I had a great time. And it's kind of embarrassing that my kids can out-ski me already. So what did it take me to get to where I am today? So, and where I'm today is someone that went through the military, went through the academy, got to go fly F-18s, became an entrepreneur, been doing that for 10 years, and now I have a $35 million fund. Well, you can see the statistics up there, and it started with 1 in 100 million kids. I had only 7% of those got to get into the Naval Academy. There's a dropout rate there. Only 30% of the people that got through the academy got to go be a pilot. From there, you had to be the top 5% to be able to go fly jets. There was another dropout selection for fighter jets instead of tailhook jets, which was 60%. There's another dropout rate once you started flying F-18s. And then once you're on the aircraft carrier, if you want to be the best, well, you got to be the top 2% to get the best landing grades out there. After that, only 95% of people take the easy route, and they will go, they'll go fly airlines and stuff like that because you can go make a couple $100,000 with only flying a couple days a year. But I took the harder route, which only 5% of us do, and I went to become my own entrepreneur. Only 35% of businesses will make it to 10 years, and only 5% of those make it over 1 million with revenue. So I'm not afraid of statistics, and the reason I'm here is because I work really hard, harder than most, and I make sure I'm educated on what I do. So, one of my sayings is when things get tough, that's when I do my best work. And that's really the biggest dropout rate when you're learning to fly planes. Almost everyone can go learn to fly a plane, but when you can handle situations in real time doing 400 miles an hour, that's where people start dropping off. All right. So as I told you, I started my life, probably the bottom 5%, bottom 10% of the wealth in the nation. And I have been able to, in my short 40 years here, been able to move up to probably the top 10% of wealth. And so that was not easy to do because if you look, the top 5% is in that orange box. And so I had to move myself across this big hurdle of people, the other 95%, which we're going to call the majority today. So only 1 to 5% of Americans know how to create wealth. That's because the 5 or 10% that are there are probably trust fund buddies and stuff like that. And so it's very few that actually can maneuver to become wealthy. And so when I put these 2 slides together, I come up with this. The majority of people are wrong. Your friends, your family, the headlines you're listening to, the majority of people are not doing things right. Now, why is that? Because everything that you are fed is not to feed for you to become wealthy, right? Wall Street's not paid to make you wealthy. They're paid to get you to invest. The headlines are not paid to get you wealthy. They're paid to get you to read those headlines. And so what I would say is take everything with what you see or read with a grain of salt and start trying to make decisions for yourself. Now that is what I have to do, and that's what I do running my own fund. A perfect example of this is the same stock from the same day. We all know Apple stock. But if I wanted to be bearish on this stock, I would show the first one. If I wanted to tell you how great Apple's doing and that just has a short momentum stop, I could show you the bottom graph. Here's another example. Beware of headlines. This was on February 9th. Goldman Sachs, a very reputable company, said that they are predicting that the Austin, Texas would decline by 25%. I'm going to show you in a further graph that we had already declined 25% by the time that this was posted. Also, Zillow saying that, we're up 0.1% since last year. Once again, a lot of people look at Zillow, they look at Redfin, they look at these sites to try to get their information and make decisions. I'm going to show you why both of these are 100% incorrect, even though they're both well-known, reputable headline companies. All right. I manage my own wealth. I don't have financial advisors, and so I can't afford to be wrong. And this is why I spend hours and days and weeks digging into the data so I can make my own decisions and put the blinders on when I'm looking at headlines. So this is where it starts getting nerdy. So I'm going to apologize in advance. But this is the easy part, right? So what causes single-family residential prices to decrease? I think we can all look at these and shake our heads and say, yes, higher interest rates, we saw that. Interest rates went up, the market's been coming down. Higher inventory, right? If there's, 2008, we've got all these houses on the market, prices dropped. If we started losing job growth, decreases in wages or deflation, we all know, we can shake our heads, we all agree with this. Well, let's turn it on its head and say, okay, well, what will cause it to increase? Well, if interest rates were to go lower, we would think that prices would increase. Inventory goes lower, there'll be more demand. Job growth goes up, people moving to your city, and wages increasing. So I'm going to show you that all these things are actually about to happen in Austin if they haven't happened already. So the first, this is just an interesting graph. During COVID, everyone was talking about the lockups in the ports. We were going to be backed up for years. This is older data, but what you can see is that 1 or 2 years that it was backed up, it's trending back to where it should be. So ideally, we're going to start seeing more stuff on our shelves, right? We're going to see grocery stores with more food and more chips coming in because they're not going to be sitting locked up in these ports. So this is just something to kind of an easy win for me to show that, as reliability comes from those shipyards, we're going to have less demand. This is from U-Haul. So U-Haul saying that in 2022, Texas was the #1 place that people were moving to. All right, it's not great data, but it's pretty good, right? Showing that the company that moves most people in the U.S. is saying that they're moving to Texas, so that's good data for us. Let's talk about demand. So over December, we all know that real estate prices have been crashing, and you'll see that here in a little bit. But this is an interesting one that when that happens, what do builders do? They freak out. They stop building. They're going to finish what they have on the market right now. That way they're not caught with a high inventory like they were in 2008. Well, if you look, the red is what happens in December of every year. And as you can see for 2022, essentially everyone stopped putting permits in for new builds. So assuming that people keep buying houses, what's going to happen 6, 9 months, 12 months from now when there's no more new build inventory because they did not even put permits in December? So that's to give you kind of the look towards the end of this year or the next 6, 9 months. All right. Now let's look at some other stuff. So this is mortgage rates. You can see that they've been skyrocketing lately. They're at 6.5%. National Association of Realtors are expecting that by the end of the year, they're going to be somewhere between 5.5 and 6.5, which means they're basically saying that they're at the top right now, and we're expecting interest rates to go down. The payroll job growth, that is showing that Texas is one of the darker blue states, so most people are moving to Texas. This is after COVID. From the National Association of Realtors, this is data that I had to pull and put together myself, but these are pending home sales. You can see that a couple months ago, it was at its lowest that's ever been recorded, but we are seeing a massive tick up already in pending sales. And then the other one is from Fred, basically showing that unemployment levels are at an all-time low right now, or pretty close to it. So all good things to show between mortgage rates should be decreasing, people are moving to Texas, pending listings are going up, and unemployment's low, that we should be expecting single-family prices to do what? Go up, right? All right. Now this is kind of a nerdy slide, but basically what this looks at is it looks at the difference between the 10-year bond and mortgage-backed securities. And so they usually move within lockstep of each other. So I had to go pull the data for both of them and put them together on a graph. And I don't know if you can see these, but there's some gray lines behind them. It's not showing up very well. And what the orange line is the difference between those two lines. And it's called the spread. And so the higher that spread is, that means there's more risk. People think less risky. When they go invest in bonds, they're thinking there's very little risk because they're just going to go, get paid back from the government. But if they want a little bit higher return with a little bit more risk, they're going to go buy mortgage-backed securities. That difference is usually between 1.5% and 2%. You can see right now it's as high as 3%. And so what does that mean? That means as the volatility slows down, and if bonds do not change, we can expect that spread to go back to its new norm. So that spread's going to drop, which means the interest rates should drop. And so it's just showing that it's at an all-time high right now, and it has the pressure downwards to move mortgage rates lower. And this is in line with what National Association of Realtors are saying. And my prediction that we're going to stay between 6 and 7% for 2023. All right, this is comparing the growth between wages for people and also the CPI. And so one thing that you'll see is when, let's see if I can put up here. Where are we? So in the orange is the wages. What you can see is we had a growth somewhere close to about 1% per year is what people were making. And then after COVID, it jumped to people making about 1.5, closer to 2%. So we saw a major jump in the what people were getting paid. And sure enough, people started to put that into to buy things, and so inflation started to go up. Now what you're going to see here is that starting in about March of last year, we are seeing a decrease in people's wages. And what we're also seeing is that is affecting the inflation, that it's starting to come down a little bit behind where people stop making less money. So this is just one of the things helping inflation come down. Now, everyone's looking at unemployment numbers and stuff like that, but on top of unemployment, you have to look at wages and how much people are actually making. This chart is looking at the 10-year bond, which is supposed to be the most secure thing out there, or one of the most secure things that you can invest in, and then the Fed rates. And so the 10-year bond's in orange and the Fed rate's in blue. And one thing that I want to show here is that, one, the bonds are more predictable, right? The Feds are trying to chase up and down and trying to, and it always comes back to meet basically where the bonds are. Basically saying, hey, the public investors that are investing know where the rate should be better than the Feds who have to keep chasing it. But one other thing to note here is in the past 30 years, every time that the Fed has increased their rates, it's pretty much topped out at where the bond market's been. We can see that here, 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 and here. Now, if you look here, the bonds as of today are right here, and the Fed rate's up here. So my question is to you is, has the Fed rate already overshot where they're going to be? And oh, by the way, they're talking about another quarter point here next month. So just another reason that if the Fed rate does come down, that's going to help take pressure off those bonds. And when the bonds come down, it's going to increase that spread that we saw from the previous slide between the mortgage-backed securities and the bonds, which is going to help push down mortgages, interest rates. I really wanted to take a picture of everyone's face when they first saw this slide, because I know no one understands it at all, but I guarantee you in the next 5 minutes you guys are going to understand it. And so this is inflation. This is the CPI. And what everyone's talking about is this orange line right here. This is the number everyone's looking at, right? So we all know that here recently it's got up to about 9%. It came down. Last month was at 6%, and actually yesterday it went down to 5%. All right? So this is what everyone's tracking, is this orange line. And the target is this blue line. This is what the Fed wants. Now, does it have to be exactly there? No. You can see the orange line goes above and below. Now, every month, if you break it down on a monthly basis and you look at it, those are what those dots are. So every single dot means that is what happened. Inflation increased by that much that month, or decreased, or sorry, what it increased by. And so if it's below this target line, I painted the dots green, and if it's above, it's red. The biggest thing I want you to take away from this slide, because we're going to dive into this a little bit more, is that it's okay to have red and green dots as long as they all even out to somewhere around that 2%, right? Now what we're going to see here is starting in 2021, we started seeing a big, there's no green dots down here, right? But there's a ton of red dots above. All right, so let's dive into that a little bit. And I'm going to show you why, another reason why I think that the Fed is overshot and inflation is going to come down below their target. All right, so this is diving down into, I'm diving into this past 2 years. And I'm just putting it out here. All right, so we're putting all those red dots above, and there's actually 3 dots below. There's another one right here that's kind of hidden just because I ran out of time. And so let's talk about this a little bit. So this is March of last year. And this is how you can figure out where the orange dots or the orange line is going to be. So this rate right here is about 8.75. And the way they did it was they took the past 12 dots, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And they averaged them together, and that's what they came out to right there. All right? Now, that's not the exact way they do it, but I can tell you that it gets you pretty close. Now, if instead of looking back 12 months, if I only look back 6 months and I only look at the 6 dots, you can see that this tells a more real-time story about what's happening right then in March of 2022. Because it gets rid of all this old data, right? And it's just looking at this new data. So this blue line, this is your 6 month, which is more telling of where we are today, because it's not looking back at so much old data. All right? So now let's look at April. So what we did in April here was we moved this box forward 1. We added this dot, but we removed this dot. This dot was higher, this is lower, so we added a lower dot. And what we saw that inflation went down a little bit. All right? Let's do the next one. All right, here we removed this dot, and we added this dot. So we replaced it with a higher dot, so what do we see? Inflation went up. Now we can keep doing that. You can see, oh man, that was a bad month, right? 14% month over month, and obviously our inflation went up because we replaced it from that dot. Now we're going to keep moving along to show you that we're removing dots from the back end, and we're adding them to the front end, but what we're seeing here is the shorter term trend is moving down faster than the longer term trend. Now as we move along, we add those dots in. Here's December, all right? Now December was a very big pivotal month for me and my company, because everyone else is freaking out that inflation is at 6 3/4 here. But what am I seeing? I'm seeing that the shorter term trend, we are actually below 3%. all right? Do you think the Fed's going to be happy if it's below 3%? I think so. They're going to get pretty close, right? And now I've seen 2 dots out of the past 12. They're starting to show that we are below target, all right? So I'm getting excited because I know that inflation's where it should be, or getting really close to where it should be. And so I actually went out, and my company, we bought $4 million worth of property. Turnkey properties, knowing that I think inflation's where it should be, and I think that it's on the trend down. Now here's why I think it's on the trend down. If I keep moving forward, all right, this is what just came out. This data point yesterday was below their target, all right? And it dramatically dropped the inflation rate because we got rid of this dot right here and replaced it with that dot, all right? So now if you look, we got 3 dots over the past 12 months are where they should be, or below target. And so we're starting to get closer to where we want under inflation. Now let's start predicting things, all right? So I'm going to make a prediction about April. And in April, we have a dot that's, it's not too bad, right? It's going to be hard to beat that. And even if you do beat it somewhere down here, it's not going to move the needle too much. So I think this is why they say it's sticky, right? They got some sticky inflation. And I don't think too much is going to happen next month. But, look at these 2 dots. We're about to get rid of these 2 dots in May and June. And when's May and June? That's the hottest buying season in Austin. So even if we come in with bad inflation numbers, it's still going to drop the overall inflation rate down, because now we're going to have at least 3 dots here, and we're getting rid of these really, really high things out of our data set. And that's why you're going to see it come crashing down this summer. Sorry, very nerdy stuff. But does this graph make more sense now?
I'm loving it.
You should love it, all right. Yeah, that's my goal, all right? We'll all be nerds together. All right, so this is, once again, let's talk about more inflation. So inflation is made up of a bunch of different services. They call them baskets, right? And it's different services. So if you put all these together on a graph and break each one out individually, this is what individually all the inflations look like. Now, if you look here at the tail end of this, almost every single one is going down just like it should be, except for this one purple one. All right, so let's dive into that one purple one. This is our shelter. And this is very important because when they say shelter, they're not talking about the value of houses. They're talking about rents. That's how they calculate it. Now, this is very important because, one, they do a terrible job about calculating this. The way they figure out rents is every 6 months, they get on the phone and they call 50,000 people and they say, hey, what's your rent? Oh, I'm paying $1,000. Okay. Well, what's interesting about that? I might be in a 3-year lease. My $1,000 could be 3-year-old data. And we're only calling 50,000 people, so, right? So once again, just like we saw in that previous, that the tail end of that, when you look back at data, it holds up what's actually happening nowadays. And so shelter, they're looking back, and they're saying, oh my God, shelter is flying up, right? And this is being added into our inflation numbers. By the way, I showed you that the inflation numbers are almost where they should be. What's even more important is, does anyone here know what percentage of all these this one is? A third. Great guess. Did I say it? Oh, you cheater. Cheater. All right. So 1/3 of our data is in this that is spiking and going through the roof. Everything else is doing so good that it's coming back down, except for this one massive lagging indicator. Now, if you look at real-time data, This is CoStar. CoStar is saying, hey, rents are going way down, right? You look at RealPage, they're saying rents are going way down. And these are real-time data, right? This is what they're putting out for their listings. So rents have already gone down, but it's not showing up in CPI numbers yet. And not only is it not showing up, but a third of the CPI is not showing up in it.
Is that showing rent going down or the growth in rent going down?
That is
One on the far right.
here.
Yeah.
That is the growth going down.
So rents can still go up.
Correct. Rents are still going up, but not like inflation is showing, right? They're showing that rents are going up by 8% on their CPI numbers.
So we're going to be house poor, but our food is going to cost less.
Or is our food going to cost less? I don't think so.
Inflation's going down, right?
The rate of inflation, remember the Fed wants everything to keep going up. They want everything to go up at 2%. And it doesn't matter, we just had this big jump, right? We just went up, you saw the one was 15% month over month. We have this big jump. The Fed doesn't want to bring it back down to where it was. It's just saying, okay, wherever I'm at today, I just want to stabilize and go back at 2%. And that's why our grandparents paid, 5 cents for a candy bar, and we pay $2 for a candy bar, whatever it is nowadays.
As we should.
Yeah, and our grandkids will pay $20 for a candy bar, because even when inflation goes up, they're just trying to level it back off. All right, and actually that comes up in one of my slides here later. That's not supposed to be on there. I'll get past there. All right, so this is straight from the MLS. This is Austin's median sales price. I don't know why the title's not up there. But I pull this data every single day and I look at it. And what I can tell you is we had a great trend going all the way back from 2003. This starts in 2003. You can't see that either. And then this is when the Fed started printing money. And you can see that people started to put that money to work. People started to move. This was right about COVID here. People started to move into Austin or into Texas. This was the third unexpected wave of COVID dropped, and this is when the third wave ended about. And then people started to buy houses again. And then this is when the Fed's like, okay, time out. Inflation's out of control. We're going to start raising the rates, right? Now, economists, they basically say that every time rates go up by 0.5%, buyers freeze for 90 days. Well, guess what? This is what happens when they raise it by 5%, right? So right here, everything started to crash. And we had everything going against us during this time, right? We had interest rates rising. We had people not sure what's going on. This is the winter months. This is August, September, October, November, December, right? Which is typically a poor buying season. And we got massive headlines saying that right here, actually this is February right here. February, Goldman Sachs is saying that, hey, we're going to crash 25% from where we're at today. So of course people aren't going to buy, right? Well, guess what I'm doing? I went out and bought $4 million worth of properties in December. Why? Because I'm looking at the data. I'm looking at what's going on with inflation. I know that these are, I know this stuff. I know that we are coming to the end of the inflation, or the end of the Fed raising rates. I see that there's going to be downward pressure on mortgages, so mortgages are going to get cheaper. And I basically was calling the bottom right here. Now, not only did I call the bottom, but I had to go, engage 170 real estate agents to go buy me properties, so I can go find ones. By the way, I wasn't buying at market value. Of course not. I'm the only buyer out there. So guess where I'm buying? I'm buying down here. So even if I was buying, if this was a stock market ticker, imagine if you could buy stocks below what they're actually valued at. So we're buying properties down here in December. Now, why am I telling you guys this? Well, I didn't have time to tell you in December because I was out buying properties. But what I can tell you is this is today's number. The first 15 days in April have been phenomenal, all right? And you're not going to hear about this for another month because everyone reports data too late. But what I can tell you is it does look like the bottom is formed. It does look like we are recovering. Interest rates are about to go lower. I've already showed you that I think inflation's under control. If not, we haven't even overshot. By the way, I don't have a graph up here, but do you know what happens every single time we go into a recession? The Fed drops the rates every single time. So these were the properties that we went out and bought. We are expecting, we're just holding for 12 months for the tax benefits, but on the cash on cash, we went and bought with cash. Obviously, banks can't move that fast. So we had the opportunity to go do that. We think that we bought them with 15% equity. And oh, by the way, that was at that value. And we've already seen that's gone up. And so we're expecting in our fund to make over 20% return on these properties. Now, I'm not here to brag to you guys about it. What I'm here is saying, where do you think the majority are buying properties? Do you think they're buying when the rates are high, like right now? Or do you think they're waiting until it's low, right? Now, when are the wealthy buying properties? It's probably the exact opposite, right? So we don't care, wealthy people don't care about interest rates, they care about value of homes, all right? Right now, and even if people wanted to buy with these high rates, they can't. Right? So it's just even more opportunity for people that can buy homes. They should be buying homes right now. So I know my opinion goes against probably 95% of other opinions that you're hearing right now, but I dare someone else to pull up all this data and prove me wrong. In fact, I challenge them. So now it's time for you guys to decide for yourself, what should you be doing with your money? Should you be buying properties right now? That's all I got. That's my nerdy presentation for you guys. I'll take questions.
The Fed is actually planning on one more increase by the end of this one.
The,
Probably 0.25%. So this was adjusted for. Is it they're raising the interest rate? Or?
no one knows what the Fed's going to do. The public opinion is that there's about another 0.25% raise.
So that was the Fed's news, not from the public. They said that on the radio that the Fed is planning on raising the
That's just the public opinion. We won't find out until next month when they have their Fed meeting what they're actually doing.
So what is your opinion, considering that looking at that graph and shifting basically around June?
Oh, perfect. Thank you.
Hello? I don't think. Is it recording even if I don't hear myself?
Did I do something?
Because I can, yeah. Can you guys? Hello? That also doesn't. Anyway, I'm going to see and hopefully people online hear me. So what is your opinion on the rates and the inflation, considering that based on the graph you were showing, provided that things continue to go sort of the same way that this month has gone, by July, that curve would have shifted, and now almost majority of the green dots will be below the target. Do you think that would be an indication for you that, first of all, inflation will normalize, but also means that the Fed will start taking rates down?
Okay, so just in case that's not working, the question she was asking is, do I expect that the inflation rate is going to be controlled by midsummer? And if it is controlled, what are people going to do?
Well,
Or what's the outcome?
eventually that will mean that, eventually that will mean that the Fed rate will start going down if inflation stabilizes after a bit.
Okay, so you're asking, is the Fed going to lower the rates? And yes, I absolutely expect it will. In fact, from my data, by the way, I'm not an economist. I've never even studied economy. This is just what I do in my free time. So, yeah, I think that they've already overshot. I think we're going to see the lag effect of people. I think a lot of people right now are holding on to their shoestrings, trying to hope that they can get through the next couple of months. I think there's going to be a lot of businesses that are going to fail because they can't afford the higher interest rates. By the way, I can do a whole nother lunch and learn about what I expect is about to happen with commercial and multifamily.
Yes.
By the way, there's going to be lots of opportunities. I've been predicting it for about 6 to 9 months now. But the answer to your question is yes, I do believe that as inflation gets back under control, that the Fed will start to lower the rates, which will help lower mortgage rates and allow banks to start lending again. That's the other thing right now. Banks are definitely afraid to lend.
Okay, we've got a microphone that is nice and loud, so here we go. If we have some questions.
Hey, Brian. I'm Rob Birch. I got a question about what you use to factor in your data when it comes to housing permits, because Austin right now, the MSA, has a record high housing permits, and some of the research I've done says housing permits tend to be a bigger indicator of declining housing prices when there's more permits than there are per people coming in per capita.
Yep. So I'll go back to this slide, the slide that I had. Wow, I had too many slides. This one was from the Texas Real Estate Center. Yeah, it's on there. And so that's obviously looking at Texas overall. But as you said, you can actually go look at the Austin permits. It's online. If you go, I don't know the website, but you can actually go and the data is all public for Austin specific.
Any other questions here in the audience? Okay, here we go.
So I think that there was also a report that came out that Austin rents are actually going down. Like, forget about inflation, they're just going down, which, I mean, for me, it's understandable considering how much they had inflated very quickly. Do you have any thoughts on that? Have you seen that? Or it might just be the source that came out with it?
Yeah, so what I'll say is I'm not in the property management group. Luckily, I hire property managers because that's the worst job in the world, I think. But yeah, if I go back to this slide, oh, nope, is it in the back? Is the shelter slide somewhere. But what it's showing is that rents are not going down yet. They're basically not growing as much as they were. And I can tell you from our personal portfolio of real estate, we're seeing about the same thing. We are still able to rent our properties, but the past couple ones that we've rented out haven't been for significant higher rents. They've basically been right where we were expecting them to be or what they had been. So, which is a complete different than what we saw a year ago. I mean, we could basically put anything up there and throw whatever number we want on, and we have multiple offers. So, but yeah. So from what I've seen personally, it looks like it's pretty much leveled off, which 1 or 2% growth rate is about the same thing as leveling off. I don't know. Does anyone else in the room have more real estate experience? Own a bunch of doors?
Yeah, I'm thinking about the same, that, it's marginal increases. I'm seeing more kind of dollar thresholds. So I had one property that we listed at 1,800, got a lot of interest in North Austin. We've got a bigger house in Hutto at 2,500. That's just, I think it's priced out of a lot of people's range, even though the comps show it's supposed to get that.
Yeah.
So I think the price, the dollar is more important than growth, and I'm seeing the growth kind of level off. The comps just aren't showing maybe $50, $100 increase you can get over last year.
Yeah, what I'll say is just to kind of verify that, if I get to the slide, next time I'm not going to have so many slides. For the properties that we bought right here, we bought these all in December, and I can tell you that it took us less than 30 days to rent these out. Now, of course, we weren't trying to get extraordinary numbers, but they pretty much rented out what the comps were saying they should have been rented out for. Maybe we had 1 or 2 just slight price decreases, but so I'd say it's staying level right now.
All right, any more? Okay, well, let's give him a big round of applause. Alrighty, so with that, if you guys have a deal or a service and you want to come up here and take the mic from me for a little bit, about minute 30, feel free to do so. We've got plenty of time, plenty of food, so if y'all want to get us kicked off, there we go. I can always count on you. Just
Okay, I love data too. That was my old job. Now my new job is working on a product for passive investors. But what I wanted to share with you guys today is a calculator that I have created, which basically illustrates the benefit of compounding returns in real estate, a little bit more in the commercial space. But you can go to wealthcindy.com, that's wealth, and then syndy.com/calculator, and play with it and check it out.
Yeah, I actually had a chance to look at that too. It's really cool, so definitely check that out. Anybody else? Yeah, feel free.
Hi, my name is Logan, and I'm a correspondent lender. So if you need any help with financing, I also have connections to hard money lenders too. Just email me at logan@relfin.com. Relfin. Relfin.com.
If you want to spell it, we do have people online, just in case.
Yeah, I'm here all the time.
I didn't even ask, was there questions online?
I checked. We're good. Okay, anybody else? All righty. Well, with that, we'll go ahead and conclude the Lunch and Learn. Feel free to stick around and network. We'll leave the food out, so hopefully y'all can take it from us. But yeah, we would love to welcome you back next month for our self-directed IRA social or for our next Lunch and Learn. It'll be one of our last ones, so do be sure to come out for it. All righty. Thank you.